Welcome to the Executive Real Estate Investing Show. This podcast is for you, the busy business owner or executive looking to create generational wealth. Here, we're going to show you how to do that through real estate investing, from multifamily to industrial and everything in between. You will become a real estate investing expert. And now, here's your host, Michael Holman.
Hello, everyone, and welcome to another episode of the Executive Real Estate Investing Show. I'm your host, Michael Holman. Excited to be here with you today. It's going to be a good one because it is, once again, an executive question show. One of my favorite, if not my favorite type of show that we do. This is where you get raw answers straight from me on what's going on, what my thoughts are, and you get to ask the questions. These are coming directly from you to me, and I'm going to answer them the best that I can. So really excited. Sometimes I get nervous when I start answering these executive questions because I don't see these questions for very long before I sit down and hit record on this. So really excited. Just know you are getting the raw answers directly. This isn't staged. This isn't scripted. So really excited about this episode. Before we get into the executive tip, though, I just want to throw out a reminder to everyone. If you haven't been on the website yet, it's executivereishow.com. That's executivereishow.com. Go check it out. Lots of good stuff. You got all the podcasts there. You have blogs. You have a bunch of resources. Really great. Go check it out. In addition, if you've been listening to the show for a while and you haven't left a rating or review on Apple Podcasts or Spotify or wherever you listen to your podcasts, please hit pause. Go do that right now. The more reviews we get, the more people that we get to reach, the more people we get to bring in to the real estate investing circle. They get to understand the power and the benefit of investing in real estate. And we can only do that when we hear people and listen to people. But to date, just so everybody knows, we have had an extraordinary response. So just take a moment before we do that. Go leave a review and a rating on wherever you listen to your podcast. And also, thank you. This has been an amazing ride thus far and excited to continue it on. Like I said, we've had quite a fantastic response to date, and we're really excited about that. Time to get into the executive tip. The executive tip today, take time with people. And what I mean by that is you need to understand that people is how everything gets done, right? People. And taking the time with people helps them feel and understand and know that you care about them, that you understand them, that you're looking at things from their point of view. And it's extraordinarily important, especially if you're a business owner or business executive and you are super busy. One of the hardest things that I found to do is to take some time out, go to lunch with somebody. Go play a round of golf with somebody, because everything is pulling at your time, right? There's always 100 things that you could and should be doing that isn't spending time with people. And sometimes taking time with people feels like a waste of time. I'm telling you right now, it is not a waste of time. Go do it. Put it in your schedule if you have to and say, I am going to take some time with X, Y, and Z person just to do it. Not because I'm trying to get anything, not because there's any kind of benefit to me. I am just going to do it. And I promise you, as you do that, you will see benefits. Even if you're not asking for them directly, taking time with people, super important. So like I said earlier, this is an executive question session and really excited to get into these questions right away with you. We are going to just start knocking these out as we go through. So the first question is from Mike S. Mike, great name. First off, he asks, what is a cost segregation study? I imagine, Mike, that you probably are hearing all sorts of things about cost segregation studies, especially if you've invested with a syndicator before or anyone like that. A cost segregation study, really simply, is just a way to accelerate the depreciation on a real estate asset. So what I mean by that, real estate depreciation, right? That's when you have an asset and you get to depreciate it. The IRS basically has in their code, that asset becomes worth less over time, right? Whether it's 25 years, 39 and a half years. There's all sorts of rules for varying ones, right? But they're basically saying, the IRS is basically saying that that asset becomes less valuable over time. And that depreciation is one of the beautiful things about investing in real estate, right? Because it's a non-cash transaction. So you can be receiving money, and that depreciation, a lot of times, depending on how you do it, can show a negative net income. And if you're listening and you're not watching, I'm over here doing air quotes, okay? Negative net income, because your cash flow is positive, but you have this non-cash expense called depreciation that you get to turn around and give to the IRS and say, look, I'm losing money. Well, that's one of the beautiful things. You're not losing money, you're getting cash, but you're, once again, air quotes, losing money. So specifically what a cost segregation study does and how this affects this is when you put together a building, different pieces of that project and of that building are depreciated at different rates, right? So while you might have let's say just as an example, right? Throw an easy number. If you have a building that's being depreciated at 25 years, if you can separate that into smaller pieces that get depreciated faster, that means you can take more depreciation up front, which reduces your tax liability even more up front, which is a good thing, right? You pay less taxes and you can carry that forward. So for example, let's say you did an apartment complex, right? Well, you're going to take that apartment complex. If you were to just straight line depreciate that, it's still good, don't get me wrong. But if you take that, now let's say, okay, I'm going to separate out the roof, and that can be depreciated. And once again, I am not giving you exact numbers here. I am not a cost segregation expert. I get them done on all my projects, but I'm just throwing out numbers. So don't go take these and go to your CPA and say, I listened to Michael Holman and he said that this is, so just know that that's my disclaimer. I am making up numbers right now, but I'm giving you conceptually how this works, right? So you have 25-year straight line depreciation. Well, you can go through and you can maybe take the roof, right? And let's say you can depreciate that at 7 years or 10 years or something like that. You take the parking lot or the site work, and okay, that can be depreciated at 7 years. And you take this, the other pieces of this building and you can depreciate them faster. Well, all of a sudden you've taken what was getting depreciated at 25 years and you're taking pieces of that and depreciating it in 7 years, which, do the math, right? All of a sudden that pushes your depreciation expense up, right? So it's sooner. That means your tax liability goes down up front. And oftentimes that's what's pushing you into that negative net income, but positive cash flow, which is a fantastic place to be as a real estate investor. So that's what a cost segregation study does. A lot of times they'll cost, anywhere between, on average, probably $5,000 to $10,000, maybe $15,000 per cost segregation study. Definitely worth it, especially if you have a big project, right? I mean, if you have a 100, 200 plus unit apartment complex, big industrial building, a full self-storage, but something like that, you absolutely want to get a cost segregation study. And that's one of the things, if you are going to invest with this indicator, just ask the question, right? I mean, it should be a simple yes. It's pretty much a no-brainer whatsoever, but you can ask the question. If they say no, okay, that's a red flag. You need to understand why on earth. Do they not understand that? Do they not know that? So just a question to ask, definitely, as you're looking to invest into real estate. Next question comes from Liz R. Liz said, where are construction costs heading? Liz, that is a fantastic question. And I wish I had a perfect answer for you. So what I'm going to do is I'm going to take out the crystal ball here a little bit. I'm in development. I'm looking at construction costs all the time. Our company, Overland, has a construction company, Overland Construction, that's really active in Utah and Arizona markets. We're building big apartment buildings and self-storage and all sorts of other things all the time. So I'm looking at this a lot. And as it stands today, as I'm recording this, a lot can change in the couple of weeks that it takes from a recording to publishing. But as I'm recording this, construction costs generally are coming down. Most people feel like construction costs are coming down, which is a good thing. I think it's artificial. And here's why I say that, right? I think the construction costs will continue to come down. They'll taper off at some point. They're not going to go down to what they were before, right? with inflation and everything like that. They're not coming down to like, let's say pre-COVID prices. That I don't think that that's possible, but they are starting to taper down. I think they'll continue to taper down and then stabilize. But here's why I say I think it's artificial. I think that there might be a small window that people are receiving a benefit from the construction costs coming down. But I firmly believe, and once again, this is Mike's crystal ball. I firmly believe that any benefit we receive in a reduction on construction costs will be replaced by an increase in construction labor. And there's a couple reasons why I say this. I mean, this is actually a pretty easy example to show. Let's just take a step back even from construction, right? I mean, how many restaurants, I don't know about you, but where I'm living, every single restaurant, every single production plant is trying to hire people. I'm hearing ads constantly. Everybody has a help wanted sign and everyone's struggling to get workers. Well, that's the same in the construction industry. If they're struggling to get workers in any industry, if you take a step back and say, okay, if you're struggling to get workers, you can't just not have workers. I mean, that doesn't work. Unless you're going to reduce your capacity and your capabilities, you can't just not have workers. Well, if you need to get workers, how do you do that? The easiest and the first way that most people are going to go to that, I'm going to pay more. You have to pay those workers more for them to want to come over. Same thing in the construction industry. If construction companies are having a difficult time getting people, construction for them doesn't just stop. They're not going to lose their market share, so they're going to have to pay more. Well, when they pay their construction workers more, they're in turn going to turn around to the owners and say, well, you now owe me more, And maybe they're not going to change a contract on you that's already in place, but those future contracts are going to be more expensive because their workforce is more expensive. So I think any benefit of a reduction in construction costs is going to be quickly offset by an increase in construction labor. So like I said, that is my crystal ball as we head into this on where construction costs are heading. So thanks for the question, Liz. Next question comes from Jake F. Talking about crystal balls, actually. Jake F said, taking out your crystal ball. Apparently that's what this episode is. This is the Michael's crystal ball episode. So let's see what this says. Taking out your crystal ball. Where do you see the real estate market heading? All right. That's another good question. As most people have seen over the last few months to a year, the real estate market has been extremely, extremely hot. A lot of asset classes are benefiting extraordinarily from this rise in construction costs. I mean, that's everything from single family homes to multifamily, industrial, right? You have a few asset classes that everybody's looking around saying, I'm not quite sure what's happening. The office, the hospitality, things like that, where people are kind of, I'm still getting the sense on a lot of that you have a few seasoned developers who feel like they have a handle on the situation. Everybody else is kind of looking around at each other and seeing where all the dust is settling, right? Everyone's a little nervous to be the first ones to go back into that. But generally, real estate market in general has been going up and up and up and up and up. Well, instead of taking out my crystal ball this time, I'm going to just tell you what I'm hearing, right? And I'll talk specifically about multifamily because that's what I've been focused on recently. So based on what I'm hearing experts say, things are going to continue to go up for the foreseeable future. And when I say foreseeable future, that's the next 1 to 2 years. Beyond that, it's really hard to say. But experts are saying that they anticipate that the real estate market continues to go up for the foreseeable future. And the question that I get in response to that is always, well, this feels like 2008, right? This is 2008 all over again. Things are going to crash. The answer is I don't know. All right. But these experts, maybe on the next executive question, somebody can ask me who those experts are, and I'll gladly give you their names. But what these experts are saying is that this is different than 2008. Right now, we're in a different situation because when 2008 happened and that whole big crash that immediately followed, that was because of bad lending standards in like the single family market. take now, for example, and let's look at multifamily and the housing market. Ever since then, there has been a disparity on supply and demand. Builders have not built enough housing year over year and consistently for the last 10 years. So this isn't something that's happened recently. This has been building for 10 years. And then what happened is not only did you have this disparity between supply and demand, now you put a once in a lifetime event of COVID in there where everybody is trying to flock to homes and they're trying to change their living and housing situations because now maybe they're working from home, maybe they want a yard, maybe they're moving because they lived in a really expensive city and they want to go back to their hometown, or they want to live in a less expensive city, whatever the case may be. There's a lot of movement happening. There's a lot of people that are upgrading homes. There's a lot of people that are increasing rentals. There's a lot of movement in the housing market. Well, what this did is this exacerbated a problem that was already building for the last 10 years. And so you have the supply in the housing market, you have the demand in the housing market, and it's just been growing. And then you put COVID in there, and it was like everything hit the fan at that point, right? And there was so much movement in such a short period of time that the markets didn't know how to catch up. And so what happens in those situations? Housing prices go up, rent increases, everything just goes up related to housing. And that's what we're seeing right now. Do I think it's going to increase at the same pace? There's still the demand supply shortage. We're still short on needed housing. I mean, that you can Google that. You can look at the data on that. That is just a fact, right? I mean, that exists. Now, what that means, that's where the interpretation comes in. So, like I said, I don't foresee it increasing as rapidly as it has over the last year. I see it continuing to increase over the next couple of years. And whether it settles down is really going to be dependent on how much supply gets put into the market over the next couple of years. I mean, for me, it really all goes back to a supply demand. And right now, supply is low, demand is high, and it's across industries. I mean, you can look at a lot of the hot markets, whether it be apartments, built for rent, flex space, industrial, right? At the end of the day, it all comes down to a supply and demand. And a lot of the red hot real estate market industries are because there's a disparity in the supply demand. Okay. Next question comes from Scott H. Why do most investments have such a short investment period? I see all of these investments have a 5-year hold period. How come no one holds on to these long term? That is a fantastic question, Scott. And there's a lot that goes into that answer, because this is a question that a lot of syndicators are asking right now. And really what's happening, the reason that you're seeing 5-year holds on a lot of these real estate investments isn't because the syndicator necessarily wants to give it up in 5 years. It's because that is what's always been done. I mean, just plain and simple, that's what investors, that's what the equity capital, who's really driving these decisions, that's what they've done, that's what they expect. And nobody wants to rock the boat, right? I mean, if you've been doing deals and you have a bunch of investors and you've been doing 5-year holds for the last 20 deals, well, the next deal, I mean, how confident are you going to be in saying, hey, we're going to hold this for forever? You're never getting your capital back. That's kind of a leap for a lot of these sponsors. So that's why you're seeing these 5-year hold periods. That is the industry standard on, anywhere between 5, maybe up to a 10-year hold. That being said, I know companies, I can think of one development company, for example, that I know that's been pretty successful here in Utah. And I was talking to one of their partners one day, and he said, yeah, we tell our investors, you're never getting your capital back. I mean, they're very straightforward. They just tell you, look, if you want to invest with us, you have to understand we are never, ever, ever going to sell this asset. So we'd love for you to invest with us, but just you're never getting your capital back. We are never selling this. And you got to know that from the very beginning. And that's worked for them, right? And there's a lot of people who want that. And so what I'll say is when you're reaching out to the masses, the industry standard, whether it be development, whether it be value add, no matter what, if you're a syndicator, the standard is 5-year. And not only is it a standard for syndicators, it's a standard with institutional money as well, right? Institutional money wants to get in, get their money, and get out. And so they want to capture that return, and you have to sell an asset to fully capture all the return. And that's why the 5-year hold. I've seen a lot of people in the market starting to question this. Why is this the case? And the point against the 5-year hold, right? There's a lot of things for the 5-year hold, right? You do it, you get in, you get out, you sell it. You've captured all the value that's been created, whether that was development, value add, no matter what it was. That's how you actually get all that money. And so that's why you want to sell, right? And people just like having cash. Well, that's the reason for it. And there's, like I said, really compelling reasons for it. One of the compelling reasons that I keep hearing, and that it's been coming up more and more as I've been talking to other syndicators and other real estate sponsors, is the frustration that it's like, I spend all this time finding this amazing asset or developing this amazing asset, whatever the case may be. And then the problem is, and I have a few investors that keep telling me this, then we hold on to it for 5 years and we sell it. And I get all this money, and that's great. But then I take all that money and I got to go turn around and I got to find another asset. And it's a pain. It's difficult. It's frustrating. Why would I want to go in and sell an asset that I know is good and have to go take on the risk of finding hopefully another good asset? And that's a valid point, right? I mean, if you have a good asset, it's good. Why are you going to sell it? You're just going to have to find another one, unless you're taking that money and going to do something completely different than real estate investing. If you're going to roll that, you're just going to have to go find another asset. And so that's really the compelling reason that I'm hearing against these 5-year holds. And so there's a lot of sponsors, like I said, and we're one of them, that's toying with these long-term holds, right? That are looking at how can we structure this so that everybody gets what they want. For example, one of the ways that we're looking at, and we haven't done this yet, but we're thinking about it in the relatively near future. And by the time some of these people are listening to this episode years down the road, we'll probably implemented this. But one of the things that we're looking at, what if we, from the very beginning, tell everyone we're never selling this asset, but we are going to get your capital back as quickly as possible. And we're going to do that through refinance. So what that might look like for us in a development situation is you put in your money, we take 2 years, we develop it, we stabilize it, and we're on a construction loan that whole period. Okay, let's refinance it into a bridge loan and see if we can get some of the money out. Because inherently, hopefully there's some value that's been created through the development process. Let's get your money back. Ideally, it's all the capital. Realistically, it might be a quarter or half the capital or whatever that may be, but let's get as much capital back as we can, take out a bridge loan. Let's hold it another 2, 3, 4, 5 years, whatever we have to do to refinance. And on that next refinance, we're going to return all the capital. Now that investors have all their money out, we're going to go refinance into the best long-term loan that we can. This is Fannie Mae, Freddie Mac, HUD, non-recourse, long-term, and we're going to hold it forever. People have their capital back. It's going to be spraying off distributions, and we're just going to hold it. And that's one that I'm seeing that's commonly coming up is, okay, how can we structure these deals in a way that we can hold these long-term? We don't have to sell them every 5 years, but we're still getting the benefit of being able to capture the value that's been created. And that's just one of the ways, right? I've seen multiple ways. Just giving you an example of what some of these sponsors are starting to come up with, including us, to figure out how to hold these long term. So that's why most people are holding it 5 years. That is the expectation. And the investors in the equity capital, whether it's institutional or retail, are driving that decision right now. Okay, that was a really good question, Scott. Thank you. Let's get on to this next and final question. Justin S. asked, how do I get into big real estate investments? And in parentheses, large apartments. Great question, Justin. And this is a multifaceted answer. It really depends on your situation, right? If your situation is such that you just have a gajillion dollars, right? You just sold a business and for $100 million and you got the cash and you don't mind managing or whatever the case may be, you could just go out and buy one, right? It's just like any other, think of it as like buying a house. If you want, you go buy a large apartment complex. Now, I give that example just in case, but for 90% of everybody else who's listening to the show, they probably didn't just sell a business for $100 million, right? There's probably a lot of people that are sitting on maybe 50,000, 100,000 up to like $1 million, right? That's kind of the range that we see a lot, 50,000 to $1 million that they have to invest. And a lot of times that might be they've been in single family home rentals or something like that, and they're ready to get out. Well, what I'll say is the easiest, the quickest, the most effective way to get into something. It looks, apparently, Justin, you're wanting to get into large apartments. My recommendation is a syndication. Find a sponsor who's doing stuff in a market you're interested in, who vet that sponsor, do your due diligence, get to a point where you feel like you can trust that sponsor. And then when a deal comes up that makes sense and that you like and that seems like it's going to work, I would make that investment. Generally, for me, I like to start off small. I mean, right off the bat, I don't go $5 million in with a new sponsor. Right, I'm going to start near the minimums, but if that sponsor and the project and everything seems to work, then maybe on future deals, I'll start ratcheting up. From maybe it's 50,000 to 100,000 to 200,000, and then I'm putting $250,000 in each deal. So there's different options like that. That's one. Another way is to JV, right? Maybe Justin, and I apologize, I don't know what the intent of the question is. That's great if you're wanting to be passive. Maybe you're wanting to be an active investor and you're saying, hey, I want to be a sponsor. I want to be a general partner. Now what? Well, if you want to be a general partner or sponsor on a big apartment complex, I'm going to give you 3 keys to getting into your first large apartment general partnership or sponsorship. Okay, you ready? Number 1, partnerships. Number 2, partnerships. And number 3, partnerships. Did I mention partnerships? Right? That is the key. If you're new to this and you're trying to get into a large apartment complex, like it appears like you are, if you're trying to get on the GP side and you're saying, look, I don't want to invest as a limited partner. I don't want to be passive. I want to be in the trenches. I want to be taking on all the risk. I want to be putting up all my own capital. If that's what you're wanting to be, my recommendation, partner. And the way that you're going to do that is you're going to find someone who either complements, and this can be a group of people. I see a lot of people that on their first deal, they might get together with 3, 4, 5, 6 other sponsors who are all looking to do the same thing. And any one of them by themselves can't do it, but 5 of them together can pull off buying a 200-unit apartment complex. That happens. Or you can go with somebody who's more experienced, right? If you can bring something to the table of someone who's more experienced, maybe I've seen it both ways. Maybe you're someone who can't raise equity capital, but you're out there hitting the streets, talking with brokers all day long, and you have a true off-market deal that comes up, 200 units. You're thinking, I'm going to put it under contract and I'm going to go find someone who can raise equity capital. You can find someone who will do that deal. It's going to take a lot of work and effort. You can likely find someone who's going to do that deal. On the flip side, I know people who's like, man, to be honest, I have a lot of friends, a lot of family. I deal with a lot of people who are extremely wealthy, but I don't have the slightest clue what I'm doing. Well, if that's you, then a lot of times you'll partner with someone who's a real estate expert, right? Someone who's developing or acquiring large apartments in this case, and you're going to partner with them, right? So those are kind of the 2 main ways that I see partnerships. Either it's a bunch of people who are new or relatively new that are partnering together to get the deal done, to get their first one done, or number 2, you're partnering with a large syndicator. Like I said, if you just sold your business for $100 million and you're saying, I got $15 million to spare, I'm going to go take a crack at it. That's totally fine. Have have fun. I wouldn't recommend that even if I had that kind of money. If you've never done real estate, it's probably going to eat you short and or eat your lunch, and but hey, to each their own. So if you have it and you want to do it, go for it. But those are really, if you're looking to get on the active side. So I just want to recap that question. Okay, because I don't know what the intent of the question was, and I want to make sure that whatever question you're trying to ask, Justin, I'm getting you the right answer. Okay, so trying to get into large apartments, if you're trying to be a passive investor, then my recommendation, 100%, no questions asked, syndication. Go find a syndicator, go find a sponsor, and do your due diligence on them and invest with them. Best way, in my opinion. If you're trying to be an active investor or a general partner or sponsor, then partnerships, right? Partner with either a group of people that can all get the deal done, or partner with maybe one experienced partner that can help you get through the process and fill in the gaps where you're weak. In any scenario, in that last one though, you have to make sure you're bringing something of value. If you're not bringing something of true value, that partnership is never going to work. And it's just going to be a frustrating experience for everyone. So make sure you have something of value that you're bringing. All right, that is it for all of the questions that are currently in front of me. We've answered all of them. So that is today's executive questions episode. I love these episodes because, like I said, when you hear those responses from me, some of these questions, the first time I read them or when I was sitting down here. So you're getting the raw answers, and I absolutely love that raw, honest feedback. So that's what you're getting. If you have a question, if you've been listening to the show for a little while and you've come up with a question, or you heard your friend say something, or you saw something on social media and you have a question and you're not sure who to turn to, go to our website, REIShow.com, and go ask an executive question. There's buttons all over. You just go there and you can ask an executive question. It'll come to us and you can get your answer read right on the show, right on YouTube or the podcast or however you're watching the show, and get your question answered. Awesome, awesome, awesome. And with that, once again, if you have not been to the executivereishow.com, you need to go. Awesome. We're filling it up every single week. It is getting filled up with more and more useful information to help you be a successful real estate investor. Last thing, once again, please go give us a rating and review. That is what's going to help increase our reach so that we can help more people learn, know, and understand about this amazing, amazing thing called real estate investing. We want to bring it to you raw. We want to bring it to you live, right? And give you honest and true feedback on what's happening in the real estate market and in the real estate world. And we can only do that if we can reach people. So go ahead, share an episode. If there's an episode that you like, go ahead, share the podcast, share the show with someone that you know. Go ahead and give us a rating and a review on Apple Podcasts, Spotify, Stitcher, or wherever else you listen to your podcast. And with that, we're going to end the show. Thank you, everyone.
Thank you for listening to the Executive Real Estate Investing Show. Ready to learn more? Go to executivereishow.com for more episodes and resources to help you create generational wealth through real estate investing. That's executivereishow.com.